We are living in unprecedented times. COVID has affected all of us in some or other way. I remember back in March looking at pictures of coffins stacked in front of the Italian churches. We felt terrified. And we've seen it reflected in all our major investment indices. Shares, property, inflation linkers, bonds, all collapsed simultaneously. Financial markets were terrified of what COVID-19 would mean for our future investment returns. If we look at South Africa, the SACI Business Confidence Index plummeted. In May, it fell to a low not seen since records began. It's recovered a little bit in July, but still well below the lows we've seen in previous cycles. The economy is in trouble. We know that. The indicators all would point to that. If we look at a study done by Oxford University, there is a strong correlation between the stringency of the lockdown, how terrified we are, and economic growth. South Africa has had now almost 5 months of lockdown. What does this mean for the economy? It can only be bad for economic growth and for company profits. There is some positive though. Inflation in South Africa is not a problem for several reasons. The oil price has come down. We have a good maize crop hopefully this year. On the demand side, because of the disruption to shopping, demand has been weak. Other costs, wages are not going up. Many people are seeing no salary increases this year. If we look at bonds, South African bonds surprisingly actually offer very good value. Why is that? That is because everybody believes that because of South Africa's sovereign downgrade, bonds are bad. Bonds are neither good or bad. It depends on the yield. At the moment, South African 10-year bonds offer you a yield of 10%. That's before inflation. The last inflation read for July was 2%, which means we are getting a yield of over 7% from 10-year government bonds. Not a bad rate. If you look forward and say, well, inflation was 2%, what's it going to be next year? Let's assume inflation goes back to 5% next year. You're still getting close to a 5% real yield from South African bonds. It's in the price. The bad news is there. The bond market has reacted to the bad news of the sovereign downgrade and our problems in South Africa. If you look at the yield curve has gone very steep. I have here the difference between the 10-year bond yield and the 5-year bond yield. Again, the steepest has been for decades, reflecting that what our fears we have about interest rates and inflation are reflected in interest rates in the 10-year area. Even better, if we look at the real yield on inflation linkers. Inflation-linked bonds are bonds which pay you whatever the inflation rate is plus a premium. For many years, these were yielding of the order of 2%. So if in those years inflation was 5%, your real yield was 2%, the government would have paid you 7% on these inflation-linked bonds. That rate has shot up to almost 5%. So if next year inflation picks up again to 5%, we'll earn 5% from inflation plus a 5% real yield. Even better, we are protected, we are insured against rising inflation. I do not see inflation rising this year, probably not next year, but in the long term, a real fear of mine is that inflation picks up substantially from what are unusually low levels in this country. The biggest fear here is government debt. If we look at the numbers here, South Africa's GDP this year is probably going to be of the order of 4.9 trillion rand. In February this year, Tito presented a budget which projected fiscal deficit for this year of 370 billion rand. On its own, already a frightening number. SARS has estimated that because of the lockdown, they will forego tax revenue of about 285 billion rand. There was no tax excise duty paid on alcohol or tobacco for the last few months. Companies are paying less tax on lower profits. Many people, maybe 1 million or more people, have lost their jobs. If you don't earn a salary, you don't pay income tax. 285 billion rand is not a bad estimate of what the government will forgo in tax revenue this year. The government has spoken about reprioritization of budget expenditure to help finance the deficit, moving expenditure from one budget to another budget. They talk about 130 billion rand. That, I think, may be optimistic, but let's use that figure. And then government has spent money on COVID relief, not as much as they talk about, but let's say 130 billion rand, excluding the UIF contribution from accumulated funds. In total, the increase in government debt this year could be of the order of 655 billion. I've even seen figures of 700 or 800 billion rand, a frightening number. Government debt in March this year was 3.2 trillion rand. If we add our expected fiscal deficit for this year, we could end up with about 3.9, maybe even 4 trillion rand of government debt, which amounts to some 80% of GDP. Now, economic textbooks talk about a tipping point. When you get to this sort of level of 80% ratio of debt, government debt to GDP, you've got two paths. Either you try and grow the economy, get government debt down, or if the worst happens, you can go into a death spiral where debt gets larger and larger, and the interest on the debt on its own becomes a very big number. Even for this year, I believe that something like 20% of government expenditure could be diverted to servicing government debt. 1 rand in 5 of government's revenue will go to servicing debt, and that will crowd out spending on other areas like social grants and education if it's allowed to continue. Now, what can government do to get out of this trouble? Now, if I can quote Moses talking to the tribe of Israel, he said, "I offer you a blessing or a curse." In this case, a blessing for South Africa would be for the government to follow growth policies for the economy. That achieves two things. Both the denominator and the numerator would improve. The denominator, which is the economy, would be able to grow. And secondly, the numerator, government tax revenue would increase. That would get us out of this possible death spiral. What could make the economy grow? Government needs to introduce growth policies. They need to allow more flexibility on labor. They need to allow competition in generation of electricity. They need to allow the sale of spectrum to telecommunication companies. If the economy can grow, a lot of our problems go away with it. The second choice is for government to follow what is called financial repression. Financial repression involves taking money from the private sector and diverting it more and more to government. This can take many forms. It could take the form of the banks being forced to lend to government. It could take the form of prescribed asset regulations, where pension funds are forced to lend to government to buy government debt, usually at lower than market clearing rates. That is bad for investment returns and also has the effect of taking money away from the private sector, where it can be invested to grow the economy, create new jobs, to the government sector, where it would tend to be used more on consumption expenditure. The third choice would be for us to allow inflation to pick up, to inflate away government debt. And we've seen that being applied in Venezuela, Argentina, in Zimbabwe. That is the worst of choices for any investment portfolio. If we look at overseas markets, we say we don't want to invest in South Africa, let's invest offshore. Now, first of all, invest as to how much we can take offshore. If you buy USA government bonds, currently the 10-year US bond after inflation is negative. Even before inflation, it's only of the order of 0.6%. It is not a good enough yield. There's risk on US bonds, and you can call that return-free risk. If you look at European bonds, it's similar. They are offering us negative yields. If we look at the rand over time tends to depreciate based on our inflation differentials. There are very few people that are optimistic on the rand long term. But in the short term, the rand does get overbought and oversold on its long-term declining line. At the moment, the rand is underpriced on purchasing power parity. If we look at the JSE, the market at the moment, the PE ratio on the stock market is a trailing 19 times, with many companies still to report for the period influenced by COVID. So our stock market is not cheap, apparently, but that does get influenced by the many very large cap stocks in our index, like Nationale Paris, Rainet, Richemont, and others, where most or all of the earnings are from overseas. These companies dominate the index. If we look at domestic South Africa, our market is cheap. I have here the price-earnings ratio for the South African banking sector. It has never been as cheap as this. It did in the great financial crisis go to similar levels, but that was truly a financial crisis. At the moment, the banks and many other domestic stocks are cheap on a long-term basis if you believe they're not going to go bankrupt. And I think most people believe that South African banks are strongly capitalized and will survive. There will be a time to buy domestic stocks like the banks. If you look at the offshore markets, if you look at the S&P index, you have to question, was there a bear market? Technically, a bear market is a decline of some 20%, which we had in the USA this year. But if you go back in history, 2000, we had a major bear market in the S&P. That was after the crash of 2000. If you recall, in the late 1990s, there was a bubble with the tech stocks. The tech stocks in the USA went to unprecedented highs, very overvalued. They came down. It took 7 years for the index to recover. Then we had the great financial crisis, 2008. It took 5 years for the market in the USA to recover. This year, the market started coming down in January. It took 6 months to July to get back to its previous all-time peak. One of the shortest bear markets in history in the USA. Was there even a bear market? When I look at this graph, I can hardly see the decline, but technically it was a bear market. Now, whether this is driven by the Robinhood day traders who are speculating and pushing up the fangs to overly generous valuations, I don't know. But you have to say that there is risk in the stock market in the USA. And even if COVID is not a problem, this requires the US economy to grow continually to justify increasing levels of stock prices in the USA. Will this happen? Maybe it will, maybe it won't. But there is risk there, and the pricing on average is not cheap. Some people say stock markets always go up, they never come down. If you wait in the long term, you will be rewarded. That might be true. It is so for many markets for most times, but there are exceptions. If you had bought the Japanese stock market after a strong bull run in 1989, we are now over 30 years later, and we are still lower than we were 30 years ago. Stock markets don't always go up, and you have to remember the rule that if markets go too high, they will come down to correct. If we look at property, another area of investment for our fund, this is a graph of the ratio of retail space to GDP. The theory being that as the economy or GDP grows, the economy can justify more retail space. In most major economies, the ratio of retail space to GDP was coming down before COVID because people were moving from shopping in shopping centers to shopping online. South Africa was an exception with massive growth in new shopping centers well before COVID changed shopping patterns. I believe that property will be oversupplied for several years before we see this imbalance going away. On property, I'm very nervous. But there is, even in property, a time to invest when pricing comes down to the right level. And now I'm going to talk about our absolute fund objectives. The PPS Defensive Fund is an absolute fund. We have two objectives. One, we try and avoid losses over rolling 12 months. That has been very difficult this year. Secondly, we try and achieve inflation plus 4% per annum over rolling 3 years, something we've done for more than 20 years. Our philosophy is one of strategic asset allocation, looking at all the major asset classes: equities, listed property, fixed rate bonds, inflation-linked bonds, floating rate instruments, money market, credit, foreign equity, bonds, and cash. We believe you switch from asset class to asset class depending on your views on the market and also on pricing. So something could be in a bad area, like property, but if the pricing is cheap enough, it might still be a good investment. Don't confuse economic conditions and good investment conditions. We apply limited tactical asset allocation, looking at forward projections. We try and use low-risk individual assets. We try and keep it simple. I've never believed that speculating, using derivatives, options, is the right way to go. Keep it simple. Avoid the complexities. Some of the worst losers after the great financial crisis were those portfolios which are trying to be very clever in the way they invested. We try and keep things simple. We also believe in having a holistic approach, looking at total risk. If you have more risk in equities, you might have less risk in property, and so on. If we look at how the PPS Defensive Fund is currently positioned, equities is the area where I think there's great long-term value in South Africa. I'm just concerned in the short term. Our equity content can vary up to 40% in terms of regulations. At the moment, we are at 18%. We have increased it from the lows, but we've kept it low because we believe there are still some headwinds in this economy. Real estate, for reasons I've mentioned, we have avoided for some time now, but there will be a time to again move into real estate. The biggest investment area we have is my favorite investment at the moment, and that is inflation-linked bonds. Those are bonds which currently offer me 5% real. I have approximately a quarter of the funds invested in bonds which will give me, if I hold to maturity, a guaranteed 5% real return, 5% after inflation. I can achieve my inflation plus 4% target without much risk. It's almost a no-brainer to have a big chunk of the portfolio invested here. Fixed rate bonds, at the moment we have a particularly high exposure to fixed rate bonds, a real return of some 7% on current inflation. It's an area I'm watching. The yields are good, but one has to keep an eye out on whether inflation may rise in the future. I don't see inflation being a problem this year or next year, but it will be something to watch in the longer term. Floating rate bonds, 18% of the portfolio. These are low risk, yielding me JIBAR plus about 1%. JIBAR at the moment is down to about 3.4%. So plus 1, I'm getting 5.5%, 6% on my floating rate bonds. Money market is there for opportunities as they present themselves in the market. Unfortunately, the yield of the money market is quite low at the moment. JIBAR today is 3.44%. The money market funds in which we're invested are still paying close to 5%, but that will come down towards 3.4% over the next few weeks. And then offshore, we have 12% of the fund. Where are our equities invested? We've tried to keep it defensive. You'll see here in my top 10 shares, 7 out of the 10 are offshore earners. Only 3 are domestically focused. That balance will change over time. My biggest investment is in Prosus and Naspers, the holding company, making up almost 7% of the portfolio. I do not believe in putting too much into any one stock. Every individual stock does have risk. Anheuser-Busch, the international beer company, a defensive business, reasonably high debt, but they have brought that down in recent months, 6% of the portfolio. Reinet Investments, a holding company for British American Tobacco and Pensions Corp in the UK, Royal Bafokeng Platinum, Goldfields. I've got 2 big gold shares in the portfolio, Goldfields, and just outside the 10, Anglo Gold. Anglo American, Impala Platinum, Spar, Afrox, all defensive type shares. Even by domestic shares, Rembrandt is reasonably defensive and offers a big discount to its asset value. Spar is a fantastic model, well-managed group, and its business is defensive. It was affected by the top stores being closed down when liquor could not be sold in this country. Those are now open, and I'm confident they will give us reasonable earnings over the next year. And then African Oxygen also is fairly defensive. It sells gas for cooking and industrial purposes and gases for hospitals and factories. I would have thought that the sales to hospitals of oxygen and other gases in recent months have been very good. If I look at the history of our stable funds that we run, it's been a difficult period. Over the last 3 months, the funds have averaged 3.2% return. Over the last year, the most difficult year I've ever experienced in my investment career, 2.8%. Since inception of my funds, we've earned a combined ratio of 10.2%, above the CPI plus 4% target. If I look at this graphically, the grey line there is CPI plus 4% in South Africa. The blue line is the track record of the funds are managed on an absolute return basis. And you can see that blue line is fairly stable. There have been two major corrections. One was 2008 and one was this year. But in all cases, we've stayed at or above that long-term trend line. I feel confident that a well-constructed fund like the PPS Defensive Fund, balanced across all the asset classes, a low-risk approach, is a sensible way of defending your money against both inflation and losses in the market. Now, often we say we've had COVID, the economy is sick, and our economy is sick. But I want to emphasize, do not emphasize a sick economy and a sick investment outlook. Yes, there are economic challenges in South Africa and for the world. In South Africa, I believe it could take 3 or more years probably before our economy recovers to where it was last year. But don't make short-term decisions. Don't confuse a bad economy with bad investment choices. South African interest-bearing assets still offer good returns. By world standards, to get 7% real after inflation from fixed-rate bonds is not a bad return. If you worry about inflation in the long term, you can buy inflation protection by holding on to government-guaranteed inflation-linked bonds. I cannot see the government defaulting in rands on inflation-linked bonds. That's our biggest asset class. We will insure it against rising inflation, which I believe is a risk in 2 years' time. Maybe sooner. Who knows? South African equities offer good long-term value. I'm prepared to hold some in South African equities, and I will increase that over time. I see some wonderful long-term opportunities opening up in our stock market. Maybe not quite yet, but there will be a time to greatly increase our equity exposure. COVID will pass. I don't know if it's going to be next month, 6 months' time, or a year's time, but COVID will pass. Either we will all develop herd immunity or vaccine will come out. PPS Defensive Fund offers a solid yield and great long-term prospects. This morning I looked at the portfolio. Our net forward yield is over 5%, a nice comfort to have in these times. And I think there are great opportunities out there to switch into more risky assets at some stage. For those investors who are concerned about the future, and we are concerned, all of us are concerned, none of us know what the future brings. None of us forecast the plague that's hit the world this year. Other things will happen. Wars, famines. We have to be prepared. For those investors that are risk adverse, PPS Defensive Fund offers a great place with a good combination of yield, defensiveness, and inflation-beating prospects. Thank you for listening. If you have any questions, we are available on the chat room, or you can phone or email us at sasfin or at PPS. Please contact us if you have any questions. Thank you.